All right, guys, good afternoon. Welcome aboard to the Aftermarket Recap. My name is Carlos Garcia, founder and CEO of G.A.R Capital. Thanks so much for taking the time out of your day to join me today and every afternoon, 5 p.m. Eastern Standard Time. Let's go ahead and talk about the market, shall we? I was just reading a couple things. My apologies. I wanted to get some charts ready for you guys. So the headline said, this is the worst first half of stocks since 1970. And that's a fact. So kind of want to give a little bit of context beforehand. Now, this morning I had someone say, "Oh, you're always bullish, this and this and that," and I've been told that many times. But yeah, I'm always long because I own stocks. I mean, I do have a bias to my long equity positions, of course, but that's nothing new. Most people already understand that. I own Bitcoin. I still buy crypto. Yes, to me, again, same thing. I'm not looking at it between half and half, year over year. I'm looking at longer term. But that's just me. But again, we still trade short term. So let's go ahead and take a look at this chart. 1970 and what happened after. Now, again, you can call this optimistic, whatever you want to call it. I'm just showing you the data. You can do your own analysis on it. But again, you could see June, and in July we hit the bottom, and then we continue running higher. Now, that would be a great scenario. Doesn't mean it will be. Again, here's a couple of things I want to show you before we start going over the regular stuff. Here's from Bloomberg. Semiconductor maker adds flashing recession alarms. Memory chips. Micron just reported earnings. They beat on EPS. They missed on revenue, and their guidance was really bad. Again, remember we talked about that third pillar on Sunday about corporate earnings. Micron is giving you those numbers, compressing margins, revenue being down, and their guidance was weak. So again, this is the next shoe to drop. So the 1970 thing, that could be an analog. We talk about analogs all the time, but at the end of the day, we still haven't really priced in uh, the multiples based on lower corporate forecasts. We're still running on the forward earnings that we got last quarter. A lot of things have changed since that quarter, as you know. June being a rough month for stocks. Let's go over that chart right quick. Here is your year-to-date performance on stocks. You can see that energy staples, healthcare, and utilities. Some industrials did well. Some communication services did well so far this year. And a couple of pockets here and there like IBM. But for the most part, a lot of risk off. Consumer defensive, that's more recessionary play. Healthcare, we know the drill. That's another well, not really recessionary, but a pretty constant, not high risk, especially with an aging baby boomer population. You know, I've been always saying UNH is one of my favorite stocks to own, has been performing relatively decent, especially in this market, up 2.7%. Energy, the energy stocks have finally shown some life for about 3 years being in the dumpster. Remember, energy was dead money for 3 years. So finally, they're coming around, especially if you own energy stocks. Let's go and take a look at 1 month performance. Here's the month so far. Not a lot of pockets of green here. Some defensives. You have Costco pretty flat. Dollar General had a good quarter, 8% for the month. Excuse me. General Mills, again the cereals, again the defensive name. CRM, even with the insider selling that we're still getting from Mark Benioff, the CEO, up 3.34%. AbbVie, Bristol Myers, UNH. Again, guys, Fed rate hikes are not going to affect names like Johnson and Johnson, AbbVie, or Merck. They're pretty insulated against that. Energy stocks down. Again, we got that overshot. I'm still waiting for 90.95 a barrel oil. We might get there. Let me get to my next point, and then we'll go over today's action. So here's the semiconductor maker adds flashing recession alarms. Again, the Fed is trying to slow the economy down. The poison pills recession. Memory chips giant Micron joined cruise lines. Remember that note that Morgan Stanley put on Carnival Cruise Line? That might be even worth zero at one point. They just said it could be zero. Potentially sending an economic warning beacon. Shares initially tumble on soft forecast as consumers trim outlays on computers and phones. Watch for more commentary during the company's 6 p.m. call. That's on Eastern time. Anything that shows up, I'll post it on Twitter. Earlier, the data showed consumer spending fell in May for the first time this year, and prior months were revised lower, helping deepen a first-half S&P 500 sell-off, largest since 1970. We went over that. Now, here's some good news. Gas prices leading inflation lower to give Fed room the ease to break. Now there's the next setup. Okay, now we're starting to price in recession, but not in corporate earnings. The Fed being the key. The Fed, if they take their foot off the pedal, just like in 2008 after 2018 after their hike and it got pulled back, we had to bounce. the Fed will lead us the charge. Again, short term, again, you can trade either way. That's why we do technical analysis. That's why we're here every day. But in terms of a longer term, let's say through 1 to 3 years, or maybe next year, you'll see recession, any kind of inflation fears come back down on obviously on the back of the economy slowing, possible recession. The GDP now that was reported today by the Atlanta Fed, reported just last week, being green. Now it's not red. Again, we already had 1 quarter of negative GDP growth. We know that too is a recession. Let's go over it today. Okay, S&P, let's take a look at the Dow, down 0.82% today. NASDAQ down 1.33%. S&P down 0.88%. The VIX down up 2%, 2871. Small caps did fare better than the rest of the majors, 169.13. The dollar index was red today, which was nice to see. Did help put stocks up a little higher towards the midday. Did bounce a little bit towards, but again, ended the day red. Now, taking a look at S&P real quick, if we just cancel out the actual the downfall that we had overnight, the S&P actually ended green. All the real action was done pre-market. Then we had a boost all the way till 1 o'clock. We clocked some spy calls today, and then we caught them and we sold. We got them out, and then look at what happened. We fell as well. So a tough tape because we're so choppy. If you're just looking at from 9 to 4 o'clock, the S&P actually ended the day green. But again, if you have to add the overnight with futures, that's why we were down 1% on S&P. A little resilient, sure, nice, maybe. The one thing that I would say was a nice thing to see was actual bonds go higher, bond prices. Investment grade up 0.30%. Government debt 114.87 on a 20-year TLT. 10-year yields, take a look at it here. Bottom left-hand corner. Now we're starting to test some meaningful support on TNX, which is the 10-year yield treasury. Why is that important? That has to deal with mortgages. Again, a lot of people are still looking for homes. So again, again, lower home costs at least. Now we're starting to see possible cracks in terms of housing. Housing prices are going to fall. In a sense, nature is kind of healing. But again, we're going to have to eat our vegetables, meaning slow down in order to lower prices. The only way you can lower prices, guys, without controlling supply is that you have to kill demand. And how do you do that? You make money more expensive, less accessible, hence rate hikes. Again, now you see, even with our rate hikes already priced in, we're 50, 75 basis for the next one. 10-year yields are not showing any kind of structure where they're showing any kind of inflationary fear as of right now. Being below 3 is big. Get below 2.28, 2.8. Then we could start having that discussion before about possible, maybe, again, a very small chance. We had the PCE today that was better than expected. Maybe we did hit peak inflation. Maybe. Again, now we're starting to begin peak demand destruction then, if anything, right? Can it kind of kill the consumer? Let's take a look at the S&P, that chart I was talking about, and that downward channel. We're still in the middle of it. We haven't broken anything out of it. The only thing is that we got as high as 39.50, 50 handles away from the apex that I expected us to get. We didn't get there. We reversed. This I expected as we hit 4,000. So 50 points too late or too early got us to where we are today. Your next support level, guys, you're talking about right around 35.83 if you're taking a look at this channel here. And if you're looking for resistance for any kind of pop, 39.92. This is based on SPX spot, S&P. Gold was down today, 0.61%, even with a down dollar. Silver down 2.61%. High yield credit pretty flat, but yet the NASDAQ was down. That's interesting to watch. Crude oil down 3.43%, 106 a barrel now. Again, it's been a volatile ride, but even oil was red this month. So again, even the commodities. Now we're hugging the 100-day. Do we break it? 90 to 95. I want to add to some energy. Gasoline futures continuing to fall. Pretty good to see. Possibly we get some savings at the pump. The problem is that if we start saving consumers money, they're going to spend, and we'll get back to inflation. So again, do you really want gas prices to fall that quickly? Then the demand picks up. Soft landing is going to get very, very difficult to get as much as far as we go. And Bitcoin down 7.6% at 18,650, and Ethereum is hovering right above 1,000 at 9.87%. And that's what we got for the day. Let's answer some questions. Nepali is asking, can we see short squeeze tomorrow relief rally? Let's take a look at S&P. 28 of the last 30 July 1st have been a green day, based according to the stock market almanac. Now, is that something that we can just hang our hat on? Not really. But again, the really key level here now is 37.40. That was the wick low. The next level for me to want to go long, you have to get above 38.40. So again, we had the overnight fall, we bounced, and now we're kind of in the middle range, 37.81 between 38.20 and 38.40. So the question is, if we can get above 38.40 tomorrow, yes, then we can get a short squeeze. But we have to see what overnight implication we get, because we could always retest 37.40. If we're looking at gaps to fill on S&P, you had a gap that we filled earlier today. We have a gap down over here, the last one to fill at 36.90. Good afternoon, Carlos. Now that MU reported slow forecast, what is NVIDIA good level to buy the stock? I wouldn't want to buy it here as of yet, because SMH, meaning, well, look at MU now. MU is, wow, kind of bouncing back. Let's wait for the conference call at 6, because they're going to give us a lot of insight in terms of the semiconductor market. And then we want to see the analyst reports that I'll get tomorrow on Twitter. I'll retweet that and see what we get. If we start seeing some analysts bringing down the values of NVIDIA, AMD, MU, and Qualcomm, then we'll start making some deductions based on that. I'm thinking to go in a margin 18K all in for TQQ for a quick trade. What do you think, Carlos? No, please don't. Don't do that. Don't. Go to Vegas if you want to gamble, my man. Go to Vegas if that's the case. Thoughts on Burry said that the United States labor market is about to be sliced in half, with blue-collar workers remaining sought-after commodity, while white-collar workers see job losses and falling wages. I actually kind of agree with that. The stay-at-home economy has actually opened up companies to see that, if you can work from home, you can work from India. We can get someone to replace you. And I've always been of the mentality, even since the COVID lockdowns, how important were delivery drivers, people stocking up shelves, working blue collar jobs. That was way more important than any middle management working for, a white collar firm. The blue collar jobs, the food service, the janitorial, that stuff, garbage pickup, kind of the infrastructure stuff, those blue collar jobs showed their importance during the lockdown, because they couldn't afford to stay home. You can't just stay home if you're working, sanitation either. But the white collar workers got to stay home, work from home, have multiple screens or what have you. So yeah, I expect if we do have job cuts, it would be definitely those first. We don't have enough truckers out there, guys, especially for any kind of infrastructure or delivery or anything like that. It's so important to have these truckers on board, because the problem with that is we've been told now for years that trucking is going to be automated. Now, again, if you're someone that wants to go ahead and get into the trucking industry and you don't work for a company, you want to just make it on your own, you have to buy your truck, look at the fuel costs, look at insurance costs. And again, you're being told that your job is going to be automated, just like the steel mills or the worker mills back in the post-war boom, 50s and 60s. That changed. Automation changed everything. Technology, guys, I've been saying it, is inherently deflationary. The more we innovate, the more we automate, the more jobs are going to be cut and people are going to be left behind. It's either adapt or die in an economy, unfortunately. It's a knowledge-based economy. It's based on what you can do. And, there's certain things I don't think that can ever be automated. Maybe sales would be one of them. I would say that's a big one. But I don't think you're never going to have, robots, in a sense, taking out the trash for you guys. Now, you do have trucks, but someone needs to drive them. And again, that's what I mean, food service. And in terms of robots, someone has to cook the food, all that good stuff. So yeah, I actually agree with that sentiment with Michael Burry. I'm down Google 24%. Should I hold? Should I continue to hold or take it? Time horizon is more than 10 years. Well, that's really your answer. If yours more than 10 years, there's no point of touching it. Now, again, Google is going to have a stock split on July 15th. I believe it is a 20-to-1 split. I might be incorrect. Looking at it here, if we go back to just 2021 February, $22,000 Google. That's my buy level for that name that I've been wanting to add more. So again, we're kind of consolidating here. We're just waiting. Google is pretty strong. Obviously, we know their balance sheet, but again, it is based on business ad revenue. So again, they're not as, in my opinion, I guess like a fortress the way a Microsoft is. I think Microsoft would probably be better instead long term, but Google is fine as well. I like both. But Microsoft here, again, we need to see the earnings revisions to start making decisions based on what's cheap. Again, what may be cheap today might be expensive tomorrow based on their earnings. In terms of PE multiple, we have the P, we have the price, but we don't have the E yet. And that's the difference. That's the last piece. If you guys want to go back to the Sunday video, I talked about, again, the consumer, if they're working, that's what props an economy. Then you also have the earnings. That's the other one. Very, very important. That's the other thing, the other shoe to drop. So again, we're still working on just half data right now because there's so much more to come. July is going to be extremely important. Tomorrow, first of the month, we'll get those 13 Fs. Let's see what the hedge funds have been buying. Again, one thing is saying something, but let's see what these guys have been doing. Again, look at energy down this month, but Warren Buffett's still buying Oxy. What is he seeing that no one else is seeing? Again, you want to see where the smart money is going. Sometimes they're right, sometimes they're wrong, but it's important to have the perspective. Best stock you own currently, ROI, it would be United Health. United Health right now, I believe, let's see, United Health right now, ROI 132%. Again, I don't have tons of shares. I bought it at 220. It's worth 513. And United Health has been one of my favorite names to own long term, just for the simple fact of that they're an insurer. They get insurance premiums that gives them extra cash and that buffer for operations. And also, they're the largest insurer in the United States for health. And we do have an aging population coming along. The aging population, the baby boomers, health insurance, they work with Medicare. United Health is one of my favorites. So again, that's the one that's performed the best for me. It's been a bloodbath. I mean, there's nothing else you could say. It's been absolutely ugly. I mean, guys, I still have football. Football has been trash, destroyed. I still have THCX, which is cannabis, trash, destroyed. Bitcoin fell, but I'm still at above my average price. But these are the hits, guys. You just take them. Been trading professionally now since 2014. I've seen it. 2018 we had the Fed rate hike. 2020 we had the COVID. Now we're at 2022, and then probably 2024 will be the next one, or so on and so forth. You just go through it every time. And the only thing that is the really important thing is, can you make money out of that? Can you make money out of the information given to you in order to move forward? And again, we're at a time that we have not seen since 1970. Hell, the past 2 years for anyone living that's under 30 years old has been an absolute mess. For all you know, this is all you know. You probably think that the market has always been this way, and it hasn't. It's been an absolute weird, weird time. I mean, it's been an absolute strange time, really, if I could be honest, since the financial collapse in 2008. Times have very much changed in terms of the stock market and economics. I mean, we are now really closer to a Japanese economy where it's just going to be low rates forever. Deflation, that's what I worry about the most, is deflation. Because that's actually worse than inflation. At least you have demand. Deflation, you have is zero. You have to lower prices so low in order to have someone to buy something. And remember, 70% of the economy is still the consumer. So again, that's what kind of worries me at night. Inflation, I can understand. We've had bouts of that. But deflation is a really scary thing. Go ahead and look up Japan, lost decade, 1990s. You'll see how bad it becomes. Some weekend reading, let's just say. I'll catch you guys tomorrow for the morning note. Let's make it a great Friday. I'll keep an eye on futures. Anything new, make sure to follow us on Twitter at G.A.R Capital. Thanks again for your time, guys. I love doing it. I love answering your questions. It's always fun to do. It'll always be free. And again, we have tons of videos. I never delete them. So again, take a look at our videos from 2020 that we've done, 2018 as well. And again, we've been here before, guys. A lot of fear out there, and I understand. It doesn't feel good when you see red. I see it every day. But this is what we do. If it was easy, guys, everyone would do it. This is difficult. Give yourself some grace. Have a great rest of the day.